Thank you all for coming. I'm sorry I don't have any introduction music. I'm actually not in the office today. I'm on vacation, so I can't play any theme music for you to get you set up and started, but we're happy everyone is here. Thank you for all the new participants. Thank you for all the returning participants. And if you're new to the platform, this financial literacy series we do yearly during the month of February, once a week. And this is an opportunity for you to learn new information about taxes, investing, stock. Any questions that you have can always be directed at Miss Anthea Perkinson. She will answer all your questions. So with that being said, I am going to toss the ball over and let her begin. The floor is yours.
All right, great. Thank you very much. I appreciate the introduction. And for those who've been with us for the first 2 weeks, we did talk about investing in our first meeting, and we launched an investing contest. I hope you're finding that engaging and fun. Our last presentation was about taxes, how to prepare taxes, how to do tax planning, because as I said then, it's not what you make, but what you keep. And there are things you should know, particularly as your income increases over time, to protect yourself from the tax man. So today we've got a great topic. We are going to talk about dealing with debt. We're going to start with student loans. We're going to spend a fair amount of time on the public service loan forgiveness program. Many of you will qualify for this, and it may be a wonderful way to get out from under your student loans once you're off and working. Then we're going to pivot. We're going to talk about credit cards, another form of debt that people accumulate. And we're going to talk about the best ways to get out of debt, saving you time and money. All right, digging right in. Federal student loans. The reason these are so popular is that they're easy to get. You don't need to have a great credit score. You fill out FAFSA and you will either be approved for income-based loans, meaning that your income, or as you're an undergraduate, your parents' income qualified for a financial aid letter that include what were called subsidized loans. Now, 8 years ago, it mattered whether you had subsidized or unsubsidized. There were different interest rates and lots of different characteristics. Now the interest rates are the same. But what is different is that with a subsidized loan, while you're in school, the interest does not accrue. The interest only begins to accrue once you graduate or leave school. With an unsubsidized loan, and all of them for graduate school are unsubsidized, the interest is ticking along as you are in school. So that is something to bear in mind. Other benefits of the federal student loan program is while you're in school, you can defer your obligation to pay loans. Right now, everybody who has a federal loan is in forbearance because of the pandemic, but you can request a forbearance if, for example, you are unable to work and pay your loans. The interest continues to accrue while you're not paying it, but you are relieved of the obligation to make payments for the period of forbearance. And of course, federal student loans, certain types, are eligible for public service loan forgiveness. Now, we have to keep track of our loans. I'm always surprised how many people forget how much they borrowed and how many individual loans they have. The government obviously has a directory of these. This is the website where you can use your FAFSA ID and look at how much you have outstanding, find out what the interest rates are, find out who the servicers are. And to avoid late fees and charges, you should have this information at your disposal. Keep your contact information current with your loan servicers. People often go to undergraduate in one state and graduate school in another. And unless you inform your servicing agents, they won't know that you have a new address. And if you are interested to learn now what the repayment plans are, the federal website is the studentaid.ed.gov website. That's the official Department of Education loan website. There are better organized sites, and I'm going to share some with you, and better sources of basic information before you go in. You know, as with many, excuse me, many government designed websites, it is information rich, but organization poor. And you can wander around in there extensively without finding answers to your questions. Before you select a repayment plan, put together a monthly budget. Don't assume that you're going to be able to cover the number they tell you. You really have to sit down and understand what, you know, what's your rent? What do you need for groceries? What do you need for all your essentials and a little bit of a life before you can make a commitment to how much you can afford to pay every month on your student loans. The standard repayment is 10 years. So if you don't elect something different before you're out, this is what you will get. It is the default option. There are other options, which would include a 5-year repayment, which is probably not in anybody's best interest. Obviously, your payment amounts go up dramatically if you're paying it in half the time. There are no prepayment penalties for student loans. You could literally graduate, have these obligations come due, and pay them off in one lump sum, no penalties. So there's no reason to elect a super short repayment option. You can extend the payment option, 15 years up to 25 years if you've borrowed over $30,000. Now, before that sounds good, understand that that increases how much you will pay in interest over those additional years. There are income-based or income-driven repayment programs and income-contingent repayment. I'm going to give you some resources where you can read up on these and understand what the differences are. Lots of people lose track of their student loans or come out, don't get a job right away, end up sometimes deferring properly, sometimes ignoring the loans, and they can go into what's called default. If you don't pay the loans in 180 days and make no effort to reach out to the servicers, you risk going into default. And once you're in default, you can't get new loans if you need them, and you are prohibited from entering public service loan forgiveness, forbearance, the whole 9 yards. They can be rehabilitated. You can call up and ask for help. And once you are in an affordable and reasonable payment plan and you keep it up for 9 months, now you've reset the clock, you're in good standing, and everything is available to you. Federal loan consolidation. You hear a lot about this, and it is a tempting thing to contemplate. If you come out of school and you've got, it seems like a bazillion different loans, multiple different servicers, and it just seems like a big mess. It seems rational to want to roll them all into one payment that you make every month, but you really want to think about that hard. What happens in a federal loan consolidation is you get a weighted average, it's not even perfect weighted average interest rate. It's a weighted average of all your loans. So if your biggest loan is your most expensive loan in terms of interest rate, the whole new balance, all rolled together, will be at that higher rate of interest. So pick and choose that carefully. There are places where you can use a widget to figure out what your new rate and payment would be if you consolidate it. And I'll share those websites with you. Pros and cons of doing the consolidation. This is one of my favorite websites, studentloanhero.com. I'm going to show you the homepage for that website. They have a lot of really good editorial content on when it makes sense to refinance your loans, when it makes sense to consolidate, how to pick the right repayment program. And great website. All of the information is vetted and very, very good. And they talk about different treatment for undergraduate loans versus graduate school loans. To make the execution happen, so say it makes sense for you to do a consolidation, do this on the studentaid.ed website. You are less likely to have a problem if you do it yourself under your FAFSA ID online. If you call up your servicing agent and ask them to do this, there's a good chance, if you have loans in all different places, hopefully they direct you back to this website, but if they attempt to consolidate it, you may have problems. Now let's talk about public service loan forgiveness. This program has gotten a lot of press coverage recently, mostly because up until October of 2021, nobody had any good thing to say about this program. It was designed to allow people who graduate with student loan debt and elect to work for not-for-profits, public interest, the government, religious organizations, universities, hospitals, anything that is a 501c3 organization, meaning you can make a charitable, tax-deductible charitable contribution to that entity, was designed to allow people who work for such organizations who are not going to make the highest potential salary to get some relief from their student loans. You work there for 10 years, you make payments for all of those 10 years under an income-based repayment program. And after you make 120 on-time monthly payments, you submit a loan forgiveness form and you are relieved of that debt tax-free. The problem, it sounds fabulous, and it is in design a great idea. Well, they made it too hard. There are too many ways that you can actually fail to qualify for the forgiveness. And there were people who had been going along thinking they were in and making progress toward forgiveness, making payments, and didn't realize they didn't have the right income-based repayment option, or they had loans that didn't qualify. And so after a lot of very negative press about this, Congress kind of leaned on the Department of Education to sort this out. So there has been a new waiver. It was announced on October 6th, and it is a temporary correction of all of the things that were wrong with the program that allowed these hundreds of thousands of students, or loan holders, to fail to get forgiveness. So now if you look at this, the standard requirements are written to the left. You can only get credit for direct loans. You have to have either the standard plan or an income-driven repayment plan. Every payment had to be on time or it wasn't counted. You had to be employed full-time for a qualifying employer. Only forgiveness if you're still working for a qualifying employer, time of application and forgiveness. And the teacher loan thing, which fouled up a lot of teachers, was effectively disqualified, as you couldn't double count those payments toward public service loan forgiveness. So now, what's wonderful about this, if you didn't know which loan was eligible for this program, and you had a direct or a FIFL or a Perkins, they're going to now accept these and count your payments against those toward the required number, still 120. Payment periods or periods of repayment under any plan. So if you're in the income driven, or if you're in the standard, or if you're in the income contingent, all of that will count. The period we're in now, when because of the pandemic, payments are suspended until May, all of those months were counted toward the 120 for anyone who was in the public service loan forgiveness program. So if you had a late payment, they're going to waive that too, and those will be counted. If you made payments before you consolidated into the right kind of loan, they're going to count that too. You do need to be employed full-time for a qualifying employer. That's how they're going to make the, count the payments. But you can receive forgiveness if you're no longer employed by a qualifying employer at the time of application for forgiveness. So that is good because there are people who do 10 years working in the not-for-profit sector, and then they want to move on with their career. Those people who moved on before getting the actual forgiveness now have a shot at it. And now they're going to double count the teacher loan forgiveness at the same time as they do for public service. So why is this important for you to know? Well, some of you may be medical residents earning income, effectively employed full-time. If you have been making payments on your loans, particularly those from undergraduate, you may want to enter this program. All it takes is to get a form. It is the employer certification and temporary exemption waiver form. You send that to your HR department. They sign off how long you've been employed there. You send it in. You should get into the program. You have until next October, the 31st of October, to actually get in and have your payments counted. And I've worked with a number of doctors who, as residents, got into this program, and with a plan of, working in the hospital till they get their 10 years and get their loans discharged without a tax implication. So it's definitely available. It's not the job that you do. You could actually be the president of the hospital, the CEO of the hospital. It's that your employer qualifies. The income-driven repayment plans makes it tough as you go on in your career to keep that payment plan low. But once you're in the plan, you will adjust as your income goes up, but you should be able to get the 10 years, 120 payments done and have the balances forgiven. So this repeats a lot of this same information. This is the website, how you find this information about the waiver, and you can link to the employer certification form. So it is the studentaid.gov. If you just put waiver in the search bar, once you're on the student aid website, this information will come up. They are trying to communicate this, but it is a bit confusing since they're using the same form and now calling it temporary exemption waiver. All right, again, this repeats what I was talking about, and you'll get a copy of this presentation after tonight, so you'll have it in front of you. So, strategies for navigating the public service loan forgiveness program. I mentioned that the doctors I've worked with, start as residents when they're not making much money and easily qualify for a low monthly income-driven repayment amount. But as their careers go on and they start making real money, their payment goes up. So how do you fix that? Well, they use your adjusted gross income. So if you make contributions into your 403B plan, the 457 plan that's available at Mount Sinai, for example, you can keep your AGI low, and therefore your payment amounts also low. So that's a good strategy to use. If you're eligible to also make IRA contributions, depending on what your income level is, that too will help to keep your adjusted gross income low. So the strategy is to keep your own money. So you make contributions into these retirement accounts. So these are your savings. It helps to keep how much you pay against your student loan balances while you're in the public service loan forgiveness program as small as possible, and maximizes the total dollar amount that will be forgiven at the end of the 10-year period. You also want to avoid forbearance because that just stops the clock. And you want to make sure that all of your payments are being properly credited. Now, the wrinkle right now is that Fed Loan Servicing is going to withdraw as an agent or an agency that is processing federal student loans for the Department of Education. They're still on board through this whole waiver period. So they're still the ones, if you enter it, your loans will be transferred to Fed Loan Servicing. They're the ones where you look up and see what loan payments have been counted. They haven't announced who will replace them and how the Public Service Loan Forgiveness Program will be administered once they truly leave. So if you want to enter the Public Service Loan Forgiveness Program, don't just call up the service rep at your current loan servicing agency. They have made more mistakes and harmed more people financially than should ever have been allowed. You can very easily go on to the student aid website, the federal government website, and pull up your loans, see if you qualify, click the button that you want this, agree that your loans will be transferred to Fed Loan Servicing. If you are accepted, meaning that your loans qualify and you're in the right repayment, income-based repayment program, you will get a notification, typically by email, in about 3 weeks that you're in and that your loan payments are being counted. Every year, you're going to be asked to certify your annual income. Again, that's because they will adjust an income-based payment amount if your income is increasing. If you don't get credit for loan payments that you've made, you have to press them to do some research because it takes them a while and you don't want this to hold you up on forgiveness at the end. So, and again, under the CARES Act, people are getting credit for payments that they don't actually have to make. And this has been quite a boon for the past 2 years. A little bit about private student loans. These are generally credit score dependent. So very often people who've taken out private student loans, not so much for graduate school, but certainly for graduate work, they had parental co-signers. And the downside of co-signing is your name is, both names are still on this obligation. So if your parents wanted to refinance their mortgage, for example, this obligation shows up as theirs. So that could be a potential problem. Private loans have a whole range of different terms and term lengths. Some of them are offered at fixed rates, variable rates, and short or long-term repayment periods. What is confusing is that there are many banks that offer these, and there is no central registration place where you can go and look up what you owe. You have to do it yourself. So you need to keep tabs on it, all the promissory notes that you signed. They don't typically have forbearance, although some do now have some unemployment programs where you can skip a payment or two if you're not working. Be very wary of aggressive marketing of loan consolidation. When you are in the private student loan marketplace, obviously they advertise these online. You will see a lot of offers to consolidate your loans, save you money, lower your interest rate. Some of them are scams, and it's hard to know as you look at it. But you can legitimately refinance student loans. You have a question, Anthony?
Yeah, I wanted to know, since you brought up the scams, I've noticed a high increase in robot calls or computerized calls to like my landline that are talking about student loans. Do you know much about that? Should we trust every person that calls that says they're from our student loan forgiveness program?
No, do not, because these are people who are trying to slam you into some of these dubious offers. If you get a call from them, you can, screen it and call yourself. They have centralized records. So if you call in and they were trying to reach you, they should be able to pull up the screen with whatever legitimate question they have. But it's definitely in the student loan area, you call them, don't accept calls from people saying they're from your agency.
Okay, thank you.
That's a great question. I'm glad you asked it. So in the last 8 years, a whole bunch of different companies, banks and financing companies, venture capital companies have gotten into the business of refinancing student loans. Now, why might that be? Well, they recognize that the people, particularly graduate students, are going on to potentially higher paying jobs and are very good risks for this type of lending. And so they offer typically lower interest rates, which means lower payment amounts, sometimes longer terms, or the ability for you to pay off your loans faster. You can extend as long as 20 years, I've seen. You can release a cosigner through this refinancing of your student loan. And many of them, if not most, offer a payment rate, an interest rate, or dollar amount reduction if you automate your payments. Set it up as an auto check item that goes out of your checking account. So that is something to consider. And if you are considering it, that website I mentioned before, Student Loan Hero, is where to look for these best offers. They do what's called a soft pull on your credit report. So you're not going to have a hard inquiry looking like as though you're looking for a loan. So you can figure out the terms and whether it would make sense for you before you actually engage with them and make an application. So other places to look for additional refinancing opportunities are Magnify Money and NerdWallet. Both of these are finance blogs. They have websites. They do a lot of editorial content. They do things like the best credit cards for 2022. They have those types of articles every year. And they also do roundups of all of the student loan refinancing options and can help people figure out what's best for them. This is just a screenshot of what's on Student Loan Hero. And this is dated from when I made the presentation. So who's on top may be different now. And you can see that they have fixed and variable interest rates, various terms. You can refinance private loans, which many people don't think about, but private loans, depending on when you got them, had high interest rates. It might make sense to refinance those and get rid of them quicker. And you can, go through and see all of these different offers. So you can see some of these names are familiar, like SoFi. We have the SoFi Stadium for the Super Bowl the other night. But some of these other entities like Splash is less well known, Laurel Road, less well known. Some of these companies specialize in particular types of loans or particular types of borrowers. Not on here is First Republic Bank. They have been big in this space. They enter, they go out, depending on where interest rates are. They really like people who are in graduate school and who might become private banking clients down the road. So I've helped a number of clients refinance using them, and they've had a pretty good experience. Here's the homepage for Student Loan Hero, and you can see how they've organized it. So there's lots of great information in here once you start buzzing around. The calculators, I'll just point this out, are super helpful. They will help you figure out how much should you consolidate, refinance, what will your payment be, how long will you pay it, does it make sense to refinance, do the numbers add up? So really, really helpful. They make money through all of these entities that are basically advertising to refinance loans. So their content is good. It's very accurate. It's very educational, but that's how they make their money. Okay. All right. So unless we have any questions on student loans, I'm going to proceed now to credit card debt. All right, so how does credit card debt happen for a lot of people in school or leaving school? Well, what I see very often is that when you have a high student loan payment, you have not enough money to pay for the rest of your life. And more of your everyday spending ends up on credit cards. As this happens, as these balances grow because your income isn't quite enough to close the gap, you end up with high interest rates and in minimum payment purgatory, meaning that you can't really make progress against getting rid of these balances. You're struggling to keep up with the minimums. So let's talk about how we avoid this. Well, how does it happen? One of the challenges here is that people sort of ignore the power of compound interest. If you have a debt at 13 or 18 or 20%, and you are only paying the minimum, that debt's going to be with you for a very long time because the interest being charged begins to compound, meaning the interest earns interest, and your minimum payments barely keep that covered. If you don't put together a budget, I mentioned that this is critical when you sign up for your first repayment program. Make sure you do a budget so you know what you can actually afford and you get put into the right plan. Don't have a payment plan that puts you into a tailspin financially. And keeping a budget while you are paying off a debt is a very, very effective way to stay on top of it. A lot of people coming out of school obviously don't have a lot of savings. You know, they're starting out, so insufficient savings means you don't have much of a cushion if your credit cards get high and your student loans are really not that affordable. Other people are victims of bad luck. They get delays in getting hired, or they get hurt and can't work, etc. So credit card debt happens. We're going to talk about how to get rid of it. Okay, there are a couple of methods for getting rid of it. We're going to talk about the one that will cost you the least, tackling it yourself. So if you're going to tackle it yourself, the first thing you got to do is stop using your credit cards. Most people are walking around, they have, I think the average number is 5 credit cards. I've met people who've had 15. I've had people who have 1 and with balances. So it's critical if you want to, you know, bail out the boat, that we stop adding water to it. So we have to stop using the credit cards, go to all cash, or use your debit card so that you don't add to the problem. The next step is to write it all down. Open up all those statements, find the latest statement, and write down the balance owed, the interest rate, the minimum payment. We're going to focus on paying off 1 card at a time. The number 1 mistake I see people make when they're trying to get out of credit card debt is they get a little windfall. Maybe they get paid for some overtime, they get a tax refund, some unexpected money comes in, and they sprinkle it across multiple cards to try to lower them. And it doesn't really do enough to make a difference. They're still stuck roughly at the same minimums, and they're struggling to pay off the same balances. Get discouraged and start going out and using the cards again. So as we write it down, we want to have a list of every creditor, you know, whether that's Visa, Amex, Best Buy, whatever it is. List the total balance owed on each card, list the interest rate for each balance, and list the minimum payment for each card balance. Then what you're going to do is rewrite the list with the highest interest rate debt first. I'm going to show you an example. So here's an example of somebody who is $6,000 in debt across a variety of credit cards. So here's the total down here, 6,000. And you can see that their worst card with one of their biggest balances is MasterCard with a rate of 29.95%. That's pretty brutal. The most important number on the whole slide is down here. This person has done a budget and knows that they can afford to spend $650 a month to deal with their credit card debt and get out of this purgatory. So here's what they're going to do. They're going to take that $650. They're going to pay the minimum on every card except the most expensive. We'll put all the rest of the money there. And if they pay $464 against a balance of $1,500, it will take between 3 and 4 months to completely wipe out that debt. Then what they're going to do is they're going to add that 464 to 15, and in less than one payment, Macy's is gone. Roll it down again. So 464 plus 15 plus 20, gone in one payment. Add this 55 the following month. This is gone in 2 payments. This is gone in 3. And you can see how you start to accelerate through this program and get out of debt. Now, that is the mathematically sound way to handle this, to just hammer home against the highest interest rate and just go down the list methodically like this. But people are people, and this is going to be a long haul. This is, looking out many months before this is all gone. So there's another way. What I'm describing is called the avalanche method, where this number gets bigger as you roll down the debts, like an avalanche. The other is called the snowball method, where before you start your avalanche, you take your snowball and you pay off these little ones. Just get rid of them so that you're only looking at 4 debts. That's kind of motivating, right? One of the biggest challenges is that this all takes a lot of time and people get discouraged. It feels like forever that they're not using their cards and they're worrying about this debt. Having an early win keeps you in the game. So that is perfectly valid and can be a good way to go about it, even though if you eliminated this, you're eliminating one of your cheaper balances, okay? Once you do the snowball, then begin the avalanche. All right, so how do you begin your avalanche? I keep saying it because it's critical. You need a budget. You need to write down all your sources of income, document all of your actual expenses, begin with your essential expenses, what you need to live, go to school or get to work. So that's your rent, utilities, cell phone, food, and then a little bit for lifestyle spending. And then how much can you afford to dedicate to this goal? Okay, you have to stay committed. And if you're not, then you're really going to struggle. And this will become, just an endless exercise. Other ways that you can deal with debt include debt consolidation. And I'll explain how you could go about debt consolidation. So what if, we'll go back to our spreadsheet here. What if you're looking at all of this and you don't have this 650? You're covering your minimums. Oh, I have a question. Karen?
So I have my question. So when you say like the budget and paying loans, what if you are paying your loan, but also you want to keep investing and keep filling up like your Roth IRA because it's only $6,000 a year and it's a really good privilege to have that money in there? So can you do that, like pay your loans and also invest?
So you're talking about your student loans?
No, I'm talking about paying my debt and also investing in my Roth IRA.
Well, doing a Roth IRA is a very, very good thing financially, long term, provided you're not going to be short and unable to keep up your minimums. It's smart to invest early in your Roth. Now, that said, if you're in a lot of debt and it's costing you a lot in interest payments, there's kind of a trade-off. So you'd have to sit down and figure out, should I fully fund my Roth or should I get rid of some of this debt, which is really starting to weigh on me? Does that help?
Yeah, thank you.
You're welcome. Okay. So now I'll give you an example of a consolidation. There are a variety of ways that you can consolidate. One of them might be, say you work for a hospital, university, whatever, and you have access to a credit union. And at the credit union, they're willing to issue a personal loan or a debt consolidation loan at 7%. I would suggest join the credit union, whatever it takes. Usually it's, you open up a little bank account for $50. Now you're a member. Now you go and ask for one of these consolidation loans and convert as much of this high cost debt to 7% debt. How much would they allow you to refinance, to consolidate, and pay off in that manner? Now, this does a couple of good things. First off, if you can convert something that's almost 30% to 7%, you'll be able to afford bigger payments and pay this off sooner. If this was the only amount you refinanced, for example, if you did the whole lump, you'd still be able to, at a lower rate, pay it off sooner because you could afford bigger payments. So that would save you money. The other benefit of doing this is that once all of these debts go to zero, your credit score is going to pop because you're not using this available credit limit. So that will be good. And that might help you if you, for example, didn't consolidate all of this. Maybe now you take this debt and you get a 0 interest credit card offer with your new higher credit score, and you transfer this balance to 0% interest for 18 months, and you pay it down aggressively over the 18 months. Divide 1,500 by 18 months. What's that payment? Do that every month. You're not paying any interest, and you can get yourself out of debt at much less cost than 18.7%. Now, 0% transfer cards are not free. They do charge a percentage of your balance. It's usually around 2.4% of your balance. Some of them are 2.7, but that's still a whole lot better than, struggling along paying 18.7%. So it's worth looking at. The place to look for those types of offers is a website called bankrate.com. When you go on the website, we'll have a screenshot of it soon. You're going to see that they have a whole credit card section, and you can look at all of the different 0% interest transfer cards and compare them feature to feature, side by side. Makes it very convenient. So debt consolidation can be a very good option for people to help get out of debt sooner. When you owe money, it's really a cost of money exercise. How can you lower the cost of this debt so that you can pay less against it? Because you have a lower interest rate, you're being charged less interest. Hardship plans are if you're sort of in a temporary tough situation and you just need help. You can call up your credit card company, for example, and say, waiting for a payment of some sort to come in, or I'm about to start a job in another month. Can I have my late payment any late payment fees waived, consideration for the next month or two until I'm sorted out? It's up to them whether or not they'll approve it. If you've been a long time credit card customer, they likely will, because they don't want to lose you. It is more expensive to replace you as a customer than to help you out in many situations. A lot of debt settlement companies advertise on the radio and online. You hear the pitch, IRS debt got you down, credit card bills getting out of control. Let us settle these debts for pennies on the dollar, save you money. Now, these are more often than not really bad ideas. And these companies are super aggressive marketers. They pressure people to sign contracts with them. And the challenge is really in the design. What they do is they have you sign an agreement that you're going to pay them a lump sum every month, and they're going to wait and they're going to put that money into an account in your name, sort of like an escrow account. When that money accumulates to a certain dollar amount, they're then going to turn around and negotiate hard with all of your creditors to try to knock down the debt that is owed. Here's the problem. They don't necessarily, as you are making these monthly payments to them, communicate to your credit card companies. And so you go into default and they start threatening to put you in collections. So you are damaging your credit report as this goes on before they even pick up the phone to start trying to settle the debt for pennies on the dollar. Now, what do they do after they do these settlement calls and they get, your debt settled for half of what you originally owed? They turn around and sell you credit repair services. Well, you can avoid all of this by taking care of it through debt consolidation first. If you're in a situation where you really can't manage all of this, you're not a candidate for debt consolidation, it's really overwhelming, you're totally stressed out, if you call 311, New York City's government hotline, they can direct you to city-approved debt management programs. And these are run by not-for-profits, credit counseling agencies. He'll help you put together a budget, who'll help you get you organized. And a debt management program works like a much more civilized debt settlement program, meaning that they work with you, you pay money to them every month. They charge a modest fee. It's regulated by the Department of Finance. And they work with you to pay down the debts that you owe. But because they're communicating with you and with your creditors, they get interest rates lowered. They get fees, late fees waived. And so you're likely to get out of debt much faster. So that is a legitimate way to get help if you find yourself in a situation where it's getting out of control. This is a screenshot of bankrate.com. So you can see they have a whole section on credit cards, any kind of credit card you might be shopping for. Maybe you don't need a 0% interest transfer card, although you should know that it exists in case you do find that. Or they also have 0% initial spending cards, meaning that you get a period during which they don't charge interest for spending. So if you're thinking of a big ticket item, like you drop your laptop and you need to replace it, you get one of these cards, you can pay that off at no interest. So that's a place to shop for that. If you're looking for a good card that's giving you dollars back, reward miles, whatever it is, you can find those cards here. And then just sort of check out the reviews using NerdWallet or Magnify Money to make sure you're getting the right card for the way you're going to use it. Other things that they have, lots of great information. They do have personal loans, and I mentioned personal loans are how people do debt consolidation. I find that working through a credit union is much more advantageous than looking at some of these personal loans. They're harder to get. They're much more focused on credit scores. Whereas if you're in a credit union, you're treated like a member and you get better terms. Okay. All right, so we're actually at the end of the presentation, and I'm happy to answer questions. And then we're going to do a quick update on our one. Oh, great. Hi, Anthony.
Yes, I have a question. What would you say to the people that might be on the line that have thought about trying to stick to a budget, but don't know how to factor in the miscellaneous, like unexpected, like car repairs or laundry and stuff like that? Sometimes it's hard to factor in when you're going to go shopping for the little essentials and put that into the budget.
Yes, so there are some great articles that I've been recommending to clients, actually. If you Google the term one number budget, an article comes up first written on thestreet.com, which is an interesting website and blog about financial topics. And they explain how it works. They even have an interview of the woman who wrote the article. And what they talk about is figuring out what all of your essential expenses are and making your discretionary funds something that you can manage separately. So you spend less time tracking down little expenses, worrying about every little thing, because you've built a little bit of extra cushion in your regular budget. So I would recommend you do that first. Another thing that people can do, largely people get in trouble because they don't have emergency savings. So something comes up, whether it's a broken car or an unexpected bill. People are walking around complaining about their Con Ed bills right now because out of nowhere it feels all of them have doubled and tripled and people are scrambling to pay it. You can start a automated savings account. And I want to give you a great place to do this that's going to, be your backup plan to prevent you from being in scramble mode. If you go to the website, marcus.com, it's marcus.com. It's the retail online bank founded by Goldman Sachs. This is the fastest growing division in Goldman Sachs, believe it or not. They currently offer high rate savings accounts. And what I love about them is that you attach your online Marcus account to your checking account. You can set up recurring transfers of as little as $5. It'll grow at 0.5% interest. You need that money, you just call it back into your checking account. It's a fabulous way to automate savings and help create an emergency fund that will keep you from, exceeding your budget or not being able to deal with an emergency and ending up in debt. Hope that helps.
Thanks.
You're welcome. So want to turn now and talk about our investing contest. For those who are joining us for the first time, we've had an investing contest in place. So far, only team number 2 has turned in their stock picks. But the way it works is you and your team members select stocks that you are going to track for the duration of February in hope that you will beat the market. So here we have the stock market. This is the S&P 500. The S&P 500 is the 500, made up of the 500 largest publicly traded companies in the United States. So all of your big brands are in the S&P 500. Nike, Google, Facebook, Tesla, they're all there. So this is used as a benchmark, meaning that if you buy an investment like Exxon, has it done better than investing in the market? You can invest in the market. You can buy what's called an S&P index fund. And your money is spread across all 500 different companies. And when the market goes up, your account balance goes up. When the market goes down, your account balance goes down. Now, today is a great day for an update because the S&P 500 and the Dow Jones, which is another commonly referenced index, were up dramatically. The Dow Jones ended up more than 400 points. So it was a big day for the markets. This was largely because it seems like we may not have a war in between, with Russia and Ukraine. There were some positive developments on that front, and that has been keeping people, on the edge of their seats and causing the market to go up and down dramatically over the past couple of weeks. So if this good news continues, the markets are likely to surge higher. That's the expectation. So let's look how these particular investments have performed. These are the closing prices. I wasn't able to line them up properly to the screenshot, but ExxonMobil closed at $77.99, so just under $78. That's not doing so hot. The S&P 500, I mentioned it's been down. It's up a lot today, but it was down quite dramatically by the end of last week. So this is rebounding. NVIDIA is doing very well. That's up about 20 points, $20 per share, very well. Hess down a little, and it's a little bit perverse. If there were to be a war, you would see these two oil companies surge because everybody worries about supplies, that there's going to be an oil shortage because there's an active war going on. If it doesn't look like there's going to be a war, then these things sink. The speculators dump these stocks and they go down. So it's a little bit perverse, but that's what we have here. Amazon. This has gone down a bit, but it's not that far off from where you bought it, $3,130.21. And ACLS has gone up quite dramatically. It's probably the most successful stock pick here. And that's a therapeutic, Cellus Therapeutics, I think is the name of it. It's a biotech stock. So well done, very interesting collection. Great portfolio for these times since we have a war and we're interested in what oil does. And you have some online related stocks in NVIDIA and Amazon, and you have a biotech, which those are always generally pretty active. So I hope the next two teams will send in their screenshots, and we will talk about this again next week. And hopefully, we'll have more questions on it, and it'll be fun. Anybody?
Anthea, you have
Yes?
a question in the chat. Karen,
Sure.
do you mind asking that question?
Sure, sorry about that.
Sure.
Yeah, Anthea, you mentioned a site in response to Anthony's question that you said you offer to your clients. It was called like One Number something. Or...
It's an article.
Yeah, an article.
There's an article called One Number Budgeting.
One Number.
Two of them will come up. TheStreet.com just did an article on it relatively recently.
Okay.
Invest, which is an investing company for women, also did an article on this. And you'll get it when you read the two articles. You'll understand what's going on. Now, if you want a budgeting app, I have a couple of good ones that I can recommend.
Okay.
Goodbudget.com. You can look at it online. You can download it as an app from the App Store. And the way Good Budget works, it's like an electronic version of the envelope system. So you decide, what do you need for your various spending categories? You set that as your goal. And then on your phone, as you're out shopping, you punch in what you've spent. Now you can pay for it and get unlimited envelopes, but I recommend to people, don't bother paying for it. You can get up to 10 envelopes free. So you don't need to track your rent in a budget. It doesn't change every month. Right. Anything that doesn't change doesn't need to be tracked. That becomes part of your One Number. Going out, shopping, travel, restaurants, takeout, that's what you need to track, because that's where people end up overspending without meaning to,
right,
and creating credit card debt. So if you just track the things you care about, it's not going to cost you anything to do it. And it's also, because I have clients that I've assigned this to, it's really motivating, because suddenly you're going to see you make different choices. You put things down, you stop the shop, whatever it is that is your spending trigger, you're now mindful of what you're doing and you make changes. So it's a very helpful tool. Even if you don't do it forever, it can help you write your budget.
Great. Thank you so much.
You're very welcome. It was a great question. Thank you.
Thanks.
Okay.
So I was informed that one of the teams had submitted something via email yesterday. I might have missed it, so I'll share that with you
Great.
tomorrow.
Perfect.
Okay.
Wonderful. Well, I look forward to reviewing it. And what I will likely do is take your picks and backdate them to the start of the contest, because next week will be our last session, I think. And so we'll have a good sense of what has changed over the course of the month, how many of these stocks have dramatically changed in price, hopefully for the better. And we will spend time talking about the thesis, what they call investment thesis. Why did you pick these stocks? So it won't just be me talking. I want to hear from the people who picked them. And I'd like to know, whether you would pick them again for yourself, whether you would invest real money in them now that you've seen how they can change over the course of a fairly dramatic month in the stock market. And again, it has been quite volatile since January. because of what's going over, mostly what's going on in Europe, but also because the Federal Reserve is talking about raising interest rates to deal with inflation, which is starting to get very high for most consumers. Okay.
You know what? Since you brought that up, I have a quick question since nobody asked the question. How does one handle the notion of them saying inflation, we're going to increase interest rates, and then the local stores increase their prices and restaurants increase their prices, but everybody income doesn't go up? How do you manage?
So if you are on a fixed income or you have no ability to get a raise, and when you have a sudden spike in inflation and you're not getting a raise, that really pinches. The people who get pinched most are the people on fixed incomes. So think senior citizens who are on fixed pensions or Social Security. That really gets difficult. What is supposed to happen, theoretically, when they raise interest rates, it dampens everybody's interest in borrowing money. So people will decide, since their credit card interest rates go up, they're going to shop less. Businesses who are looking to take out loans to expand or buy more inventory decide to either take out a lower loan or to wait. It can depress hiring for companies that were looking to expand that way. Things get more expensive. You have to pay people higher wages, so it can damp down hiring, which is a danger. But the idea is that if you can damp down demand and spending, you will bring interest rates lower. So if you raise interest, your inflation lower, rather, because inflation is caused when there are a limited amount of goods and lots of people chasing them. The people selling those goods can raise the prices, and that's how you get inflation. So they're hoping that if they raise interest rates, and they're debating 25 basis points, 50 basis points, some people are arguing for 1%, that will be enough to kind of stop this trend. I don't know that that's true. Nobody has a crystal ball to say whether that will work or not in this instance. One of the challenges that they're facing is that some of this problem is related to supply disruption. We have not only, everybody's talking about these tankers that are out with these goods that companies can't get into the country, so everybody is waiting for things to be delivered, whether it's furniture, other home goods, clothing, the whole thing. And because that means that inventories are now scarce here, sellers are marking up the prices. So we're seeing this lack of inventory result in higher prices. If they fix the shipping issues, this goes away naturally, but it's unclear how quickly everything is going to catch up since it was so disrupted due to the pandemic.
So quick question on top of that. So if people raise their prices,
Mm-hmm.
do they ever eventually lower their prices?
Sure they do. If everybody raises their prices and then suddenly people stop buying because they're like, I'm not going to pay that much for that, then you will see it come on sale. Ironically, that's what we are used to. We are used to prices being very, very low. After the great financial crisis, when we were in a very deep and very long recession, lots of people not working, lots of companies really struggling to kind of regain their footing, we had prices starting to sink. And you saw it in certain things. Electronics got cheap. Electronics hadn't been cheap in a while, but they got cheap because people weren't buying them. Other things also became very inexpensive. Clothing, we all got used to having stuff, shopping sales and only sales. I mean, everybody got into that act. So people were very anxious, particularly around the holidays, that stores weren't going to have, great Black Friday shopping events, which are really big for their profitability, without big discounts, because people were so used to seeing prices drop and waiting to get lower prices, that we stayed in a deflationary environment for a very long time. That's why people were so surprised to suddenly see inflation. We haven't had it in 10 years. Things were going up very, very slowly, and so you didn't notice it. No. Mm-hmm. Okay.
You have a question, a hand raised from Karen?
Great.
I just want to take some moment to say thank you to you and everybody who is organizing this. I will be honest, I've been looking for like someone to explain to me these topics, and honestly, I'm so glad like I've been here, and the way that you explain everything is so clear, so easy to understand. So definitely thank you so much for even rephrase complicated terms, because economics is so complicated, but you make it so easy and so relatable, so open. So thank you so much.
Well, thank you. I appreciate that.
And my question is about loan forgiveness. So I'm planning to apply for my master program, and I need to get this loan. And they offer me like this private loan with different banks, and then there is like a public loan, but it's not like the entire amount that I have to pay for my master.
Okay.
So how should I like go with what should be my thinking process when it comes to getting the loan?
Okay, so if I understand your situation, you've gotten a financial aid award letter, and it has some federal loan on it, but also the recommendation that you get a private loan.
Yes.
Okay, so the federal loan is generally going to be a good idea, depending on which way because it has all of those benefits: forbearance, deferment, the whole bit. So that's a good piece of your financial aid letter. The private loan, they often recommend a particular lender, but you're not obligated to borrow from that lender. Remember the website I showed you? From Student Loan Hero? Most of these lenders will not just refinance, but issue loans. So what you want to do is look on these different offers, see how much you could borrow and how cheaply you could borrow it, so that you get the best possible rate.
And then I can do that just independently myself, looking it up and seeing how much the interest is going to be.
Yes. Yes. Okay. And just make sure as you do that, they all say it, but make sure they're doing, a soft pull on your credit report. So it doesn't look like you're, looking to borrow a lot of money, because that might depress your credit score.
Okay. And my question also is, while I'm a student, like in grad school, do I have to pay the loan, or my question
Some
is,
of these,
I will get interest while I'm not paying for the loan?
So if you're going to graduate school and you get a federal loan, it's called a Grad Plus loan, and they charge interest while you're in school. Now you can do something to help yourself. If you have savings or a little, job, I don't know if you will for your master's, but you can set up interest-only payments so that your interest doesn't get added to your balance while you're in school. And that will save you a lot of money. So you just pay the interest as you go every month. Maybe it's, automatically comes out of your checking account. And then when you graduate, you will have just the original amount borrowed as what you have to pay off.
Okay, so in that case, I'm only going to be paying what they are charging me for having the loan, but the
Correct.
principal will be there.
The principal will be there, but you won't have it, increased with all that interest. Yes.
Okay. And that will happen, the same thing for the federal loan will happen for the private loan.
So it's absolutely a feature of the federal loan. You will have to find out, look lender by lender, whether they have anything similar. Some of them will let you not have a payment during your school term. So that would be a great benefit if you can simply defer it until you graduate. But you have to look at the specific lenders and see what their terms are to know which one does that.
Okay. Thank you so much. Okay, That's clear a lot.
You're all very welcome. I have a question from Douglas. You unmute.
Hello. Hello.
Hi.
Yeah, sorry about that. Are you a certified CPA? And if so, can I contact you for like financial guide, like for financial advisement offline?
Yes, you can. I am a certified financial planner and an enrolled agent. So that's my tax credential. So if you wanted to reach out, I've given my not-for-profit email address, but if you reach out that way, I'll respond using my business address. So you have my contact and my company name.
Okay, thank you so much.
You're welcome. Any other questions in the chat?
No, it looks like that's it.
Okay. Well, this has been fun. I'm glad we had a lot of questions today.
Yes, thank you for your time and the presentation. I hope to get out of student loan debt soon as well.
Yes. Well,
Yes,
I hope you're in the public service loan forgiveness program.
yes, once I found out about it, I think 2 years ago, so one of the employees at Mount Sinai told me about it, so I enrolled.
Great.
Yeah.
Great. Want more people in it. Get rid of all this student loan debt. Make a big difference.
Yes.
So that'd be great. So next week, I hope you'll all come back. We're going to be talking about financial planning for life transitions and emergencies. So it's things to do, things to think about. We're going to talk about credit scores. You understand how that works and a number of other things to help you navigate leaving school and starting a job, or in an emergency, you know, what to do in what order to protect yourself financially. So I look forward to seeing you all again next week. Thanks again.
Yes.
Thank you.
Thank you all for coming out.
Thank
Have a
you.
wonderful night.